I'll get stuck into it. Thank you. So I'll start with I suppose, the very beginning. And actually, before I go into this slide, things that I'll be talking about tonight would be loan structures, how to use your equity. We'll talk about the different types of repayments. So, whether it's principal and interest or interest only, how to sort of best structure an investment loan, and also the differences between positive and negative gearing, which is some of the terminology that you might be hearing when you are looking at an investment property. So I'll start with the loan structures. So this is probably more sort of targeted towards existing homeowners and maybe how to best structure a loan. Quite often, a lot of people tend to do what we call a cross securitization loan, which means you're basically raising 100% of the investment property purchase price, and you're actually securing that against your owner-occupied property. That's a pretty common sort of practice with a lot of different people, and I find that obviously that's probably the easiest and cleanest way to structure a deal initially. However, it can be problematic later down the path when you might be looking to sort of refinance or release one of the properties from security. Standalone securities always work a little bit better because you don't always need to be with the same lender. You can typically take some equity of your current house and use that as a deposit against your next property. It just means that each property is standalone and sort of services itself in its own right. You also want to make sure that even though you might be raising some equity against your owner-occupied property, that you've got the right type of splits or the right structure. So owner-occupied properties tend to have the label called home loan, and investment properties might have the investment loan label against that. It's always best to have owner-occupied and investment loans labeled clearly, particularly when it comes to tax time and your accountant wants to be able to work out how much interest you've actually paid on the investment loan and how much is non-deductible. Other types of things to take into consideration is what type of repayments you want to make on a property. So interest only or principal and interest. And I'll just explain the two. Interest only means exactly that. You're only paying the minimum repayment, which is the interest cost each month. So what that would mean is if you're just paying interest only on a $500,000 loan, and let's just assume you've held that loan for 5 years, your loan balance will still be about $500,000 in 5 years' time because you haven't paid off any additional principal. The principal in this case would be that $500,000 balance. The alternative will be a principal and interest loan, which means every month you're taking off a small chunk of that $500,000, which means every single month that principal component is also reducing. What tends to happen, it's a bit of a sliding scale. You'll pay more money towards your interest at the very beginning and less towards the principal. But as the loan progresses, you'll notice that you're paying more and more towards your principal because your loan balance is reducing, which means that the interest charge will go lower and lower. A lot of investors tend to prefer the interest only when it comes to an investment property because they don't want to pay that loan off. They want to maximize the amount of interest that they're paying paid or charged because there's a tax benefit against that. Whereas if you've got a principal and interest loan against your owner-occupied property, there's no tax benefit for you to have that, so you want to probably pay that down as quickly as possible. Other things to take into consideration would be what type of structure or what type of ownership would you have? So when you buy an investment property, you can have it in your personal names. You can have it in a joint application. So sometimes maybe a husband and wife or even siblings or even friends. You might buy a property together. And that might sort of help you when it comes to serviceability because you can have multiple income service that one debt. In addition to that, on top of the income that you do earn, you've also got a rental income, which all the banks would add back, but that may only add a portion of that amount. So it might be about 80% of whatever rental income you receive when it comes to the purpose of serviceability. Those last few options would be trust or company. So trust or company means that the asset is protected and it stands alone. So hypothetically, obviously worst case scenario, if you were to get maybe sued in your personal name, sometimes the assets could be protected, but it's always best to seek legal advice to see what protections you might have and also speak to an accountant, just make sure that you've got the right structure. Other things to consider as well is you might have that property vacant for a period of time. So do you want to allow certain buffers? So do you want to have a certain amount of money in offset or redraw, just in the event that the property was vacant, or you might have some additional repair costs that might come out of the blue. But then also the rates could also move up and down in that time. So always allow a bit of a buffer just in case there's any sort of emergency funds that you need to cover. So one of the questions that we get often very up. So I'll rephrase. One of the questions that we get asked very often would be, do I need a deposit to buy an investment property? Quite often that answer could be no if you own an existing property. And this slide talks specifically to using equity. So how does equity work? So with this example, we've got a property that is worth $1 million. However, there's a balance against that property of 500,000. So quite often people say, look, I've got $500,000 equity in that property, which is right. However, the bank's not always going to allow you to use 100% of that equity, right? So with this example, we wanted to keep that loan to value ratio at 80%, which means that purchaser didn't have to pay anything such as mortgage insurance. So if we were to scale that down to an 80% lend, out of the $1 million, we can only raise $800,000 against that property in terms of a loan, less the balance that the clients currently own, which means we've got $300,000 in available equity. So you can use that equity and actually use that towards an investment purchase. And you can actually have that as a separate loan against your owner occupied property. So even though that loan is secured against your principal place of residence, what's important is the purpose of why that loan was raised and whether or not that's going to be tax deductible. So if we bought an investment property and we needed that $300,000 as a deposit, we can actually use that towards that purchase. And then you might raise another loan for whatever the shortfall balance might be on the investment purchase. And that's one way you can actually have independently secure properties. So you'd have a split against your owner occupied property, and then the balance of that loan might be like an 80% lend against the investment purchase. So how do we access that equity? What we tend to do is we'll order a valuation against your home. That will then determine the exact amount of valuation that we're able to lend against. What you'll want to take into consideration is valuations will definitely fluctuate from bank to bank. We've had discrepancies between valuation firms upwards to about $200,000 on the exact same property. So I suppose something to take into consideration is if you're not getting a high enough valuation, it could be as simple as maybe going to another lender and testing what valuations they were able to lend against. And also you want to make sure that you park your funds smart as well, because if you've got any surplus funds, you don't want to leave that in like a normal sort of savings account. You want to leave that in either an offset account or redraw, because you're not paying interest on that money whilst the money's parked there. So whilst there may not be any tax benefit parking that against your owner occupied home, at the same time, you're also not paying interest on it either until the funds are utilized. So the next slide talks to repayment strategies. So what type of repayment strategies will work best? As an investor, a lot of people tend to, prefer not to spend any money that's out of pocket, but in most cases, when you buy an investment property, particularly at the very beginning, you might have what we call a negative geared loan. The next slide sort of talks to that, but I'll just sort of give you a bit of an overview right now. A lot of investors tend to sort of prefer principal and interest against their owner-occupied property, and then they just want to minimize the repayments against the investment, so they'll go interest only. If they have any surplus funds, most people, once again, prefer to put that surplus money against their principal place of residence. As I mentioned in my previous slide, there is absolutely no tax benefit for you to have a home loan balance, but there is a tax benefit to have an investment loan. So, if there's a priority property that you want to pay off, it tends to be the principal place of residence. Also, what you want to have a look at is you want to review your investment property quite often. So how much rent are you getting? Is it in line with market value? What expenses can you minimize? And also valuations as well, because what might happen is over a period of time, the investment property might have gone from, let's just say that you bought it for 500,000 and then the property goes to 700,000. It might be a point where you can actually pay back the investment loan that's secured against your home loan, which will actually free up that $300,000 equity that we spoke about before. And you can shift that debt over to the investment loan. So that way you've freed up some equity against your principal place of residence. One thing I see quite often as well is banks change their rates all the time. So you want to make sure that the bank's giving you most competitive rate at that point in time. However, it could be worthwhile refinancing because some banks could be a little bit more aggressive in terms of their interest rate pricing compared to some of the others. Something that we do as brokers quite often is reprice our clients' home loan interest rates. So investment loans versus home loans, what's cheaper, what's more expensive? Investment loans tend to be slightly more expensive. Some lenders may deem them slightly higher risk because they could be reliant on your income, but also a portion of the rental income. And obviously, the rental income may fluctuate, or there could be vacancy in the property. But at the same time, whilst the investment rate could be slightly higher, it's also worth noting that that interest is also tax deductible in most cases. You want to make sure that obviously, there's not too much of a discrepancy. From my experience, some banks will only charge maybe 0.01% more on an investment loan compared to a principal home loan. Another surcharge that the banks could also charge you for is you might have an investment loan that's principal and interest. That could be that 0.1% discrepancy in rate, but then if you're paying interest only, but then the rate could be even more expensive again. So worthwhile shopping around and making sure that obviously you're sort of testing the market, because you don't want to be too far away from the next bank in terms of competition. Other things to take into consideration is obviously what additional cost does that bank have? So do they have an annual package fee? Do they charge you for an offset? Do they charge you to make extra payments? Are you on a fixed rate loan? Sometimes the fixed rates could be a little bit cheaper or more expensive, but then the fixed rate loans could have limitations with extra payments. So always do your research to see if that product is going to be right for you. A lot of the clients that we speak to, they tend to approach only the bank that they work with, and then with doing that, you're limiting your options. Another thing as well is, whilst I spoke about the price discrepancies between home loans, investment loans, but also interest-only loans again, the banks will always charge you certain rates based on your loan-to-value ratio. So in my experience, a 95% loan is going to be a lot more expensive than a 90% loan. An 80% loan is going to be cheaper again, and then a 70% loan will be even cheaper. The reason for that is the banks like to price interest rates based on risk. The lower the loan to value ratio, the lower the risk for them. So if, let's say, there's a correction in the market, you've got a bit of a buffer, so the bank's not going to be exposed or at risk if that property was to get repossessed. And that's why they tend to favor clients with larger amounts of equity or larger deposits. And just on my last slide, I wanted to talk about the differences and benefits of positive gearing versus negative gearing. So most investors, it'll be ideal for them to pay or go on a positively geared property. What a positively geared property is that your rental income is actually covering all of the interest costs and any other associated costs for actually holding that property. So costs could be things like, as I mentioned, interest. There could be counter rates. There could be insurance costs. There could be property management fees, so on and so forth. So even, let's say, for instance, let's just make an assumption that you're getting $1,000 in rent, but then you're only paying $500 in interest, and then any additional costs against that property could be another maybe $100 or $200. That would then mean you're surplus by about $300 to $400 on that property. That's positively geared. The alternative is negative gearing. Actually, before I get into that, I'll also say that positively geared properties could potentially attract additional tax, because that positively geared property, whatever that amount is, let's just assume it's $15,000 over the year, that's additional income on top of your wage, so you could be taxed at that rate as well. Always best to speak to an accountant, because there could be clever ways to maybe minimize that or structure it a certain way. The alternative, which normally results in healthy tax returns, is the positively geared structure. So positively geared properties, what it means is obviously you might be getting, we'll reverse that sort of example that I gave you before. You might be getting $500 in rent per week, but then the interest cost might be $600, but then you've got additional ongoing costs of maybe $100 a week on top of that. So then on paper, that property is losing $200 a week, right? Please bear in mind, this does not take into consideration capital growth. It's purely the ongoing cost of retaining that property. So let's just say on paper, you're losing $200 per week on that property, but then you think, look, there's a tax benefit. I might be able to get a tax refund against this property. But also at the same time, whilst it might be negatively geared, I've also got a lot of growth in this property, because the market is increasing. So $200 per week, it might be growing at a rate of, call it $500 per week. So I'm still ahead, even though technically on paper I'm losing money, if that makes sense. So that's a quick snapshot and an overview on property investment. Hopefully I've covered all your questions or concerns, or at least given you a bit of an overview on how it all works. I might sort of switch it over and stop showing the actual presentation and show it now with the camera, just to see if anybody had any questions or queries in terms of my presentation, or if there was any additional information that I may not have covered tonight. I might just answer maybe one of my own questions. So sometimes, does every bank offer interest only and investment loans? Look, a lot of banks actually do. A lot of the major banks will definitely offer investment lending. You can have, as I mentioned before, you can have, I suppose, let's call it a cocktail of like home loan rates versus investment loans against your one property. It doesn't always have to be with the same lender as well. So you can have an investment loan at one lender and home loan at a different lender altogether. I might sort of wait around for any other questions just in case someone had any. Must have had a really good presentation. I might have answered everyone's questions. All right, I might just sit tight for another 1 or 2 minutes just in case anybody had any questions. But otherwise, I really appreciate everybody taking the time out tonight. Hopefully, the presentation sort of answered a lot of your questions when it comes to investing in property. Okay, well, I might just end it on that note. Thanks everybody again for your time. I really appreciate you taking the time out. As I mentioned, my name is Polatkesen. We're from Mortgage Domayne. We're proud to be presenting on behalf of Peet tonight to their customer base. You may have some questions offline, so we will share the presentation at a later point. Our contact details will be on there as well. If you have any questions or concerns, even if you maybe want to do a bit of a sense test whether or not you've got enough equity or borrowing capacity to buy an investment property, we're more than happy to sort of take those questions offline at a later date. We're here to help. So we work with 60 odd lenders, and obviously you'll find that every bank has a different way of operating. And just because one bank may not be able to give you like a favorable outcome doesn't necessarily mean that every other bank's the same. So just keep that in mind. Well, thanks again for your time. Yeah, everybody have a good night. I will close the event off now. Thank you.
Thank you.
Thanks, everybody. Have a lovely night. See ya. Bye.